Ever wondered how to invest your money wisely? Investing can seem like a complex maze, but with the right knowledge, it becomes a walk in the park. Investing at its core is about putting your money to work for you. It's a way of stashing your funds somewhere where they can grow exponentially over time. But how does it work, you might ask? Well, let's start with the basics. Imagine you've got a seed, a tiny little thing that doesn't look like much, but plant it, nurture it, give it time, and watch it grow into a sturdy tree. That's essentially what investing is. It's about planting your money in fertile ground, nurturing it with intelligent decisions, and giving it time to grow. Now, where do you plant this seed? That's where financial planning comes into play. There are different types of investments to consider. Stocks allow you to own a small piece of a company. Bonds let you lend your money to a company or government who promise to pay you back with interest. Mutual funds are a mixed bag of stocks, bonds, and other assets managed by professionals. Then there's real estate, commodities, and so on. Each type comes with its own set of potential risks and rewards. But remember, every investment is a gamble. There's always a chance that things might not go as planned. The stock market could crash, the real estate market could slump, the company you invested in could go bankrupt. That's why it's crucial to diversify, spread your seeds in different fields, so if one doesn't yield, the others might. That being said, the rewards can be substantial. Your seed can grow into a tree that bears fruit year after year. In the investment world, this could mean regular dividends, interest payments, or an increase in the value of your assets. In the end, it's all about understanding the game. It's about knowledge, patience, and calculated risks. It's about navigating the investment maze with confidence and poise. Understanding the basics of investing is the first step towards financial freedom. The next step is to identify potential investment opportunities. So, how do you spot the right investment opportunities? It's all about research and analysis. You see, investing is not about throwing darts at a board and hoping for the best. It's about understanding the game and making strategic moves. Firstly, consider the company's financial health. Are they profitable? How much debt do they have? These are essential questions to ask when evaluating a potential investment. Next, you'll want to look at the company's market position. Are they a leader in their industry? Or are they struggling to keep up with the competition? Then think about their future growth prospects. Does the company have plans for expansion? Are they innovating in their field? Finally, don't forget to diversify your investments. This helps to spread out your risk and can lead to more stable returns. Remember, the more research you do, the better your chances of making a wise investment decision. But what about the companies to avoid? Investing wisely also means knowing which companies to stay away from. There are certain red flags that every investor should be aware of. Let's delve into these warning signs that might signal it's time to steer clear. Firstly, high debt levels. A company saddled with debt is like a ship with a hole. It might stay afloat for a while, but eventually, it will start to sink. High debt levels can restrict a company's growth and prevent it from investing in new opportunities. It also increases the risk that the company might not be able to pay back its debts, which could lead to bankruptcy. Secondly, inconsistent earnings. If a company's earnings are all over the map, it's hard to predict what they'll be in the future. And in the world of investing, uncertainty is the enemy. Consistent, steady growth is usually a sign of a well-managed company. Thirdly, questionable management practices. The people at the helm of the company can make or break an investment. If there are rumors of unethical behavior, or if the management team seems to be constantly changing, it could be a sign of instability. Lastly, a lack of transparency in financial reports. Companies are required to release financial reports on a regular basis. If these reports are hard to understand or if they're missing important information, it could be a sign that the company is trying to hide something. Transparency is key in the world of investing. Without it, you're investing blind. And remember, these red flags don't necessarily mean that a company is a bad investment. They're just warning signs that you should do more research before you invest. It's all about assessing risk and making informed decisions. By staying vigilant and doing your due diligence, you can steer clear of potential investment pitfalls and maximize your returns. So, we've covered the basics of investing, how to spot the right opportunities, and the red flags to avoid. Remember, navigating the investment maze isn't always a walk in the park. It's crucial to do your homework and due diligence before jumping in. Spotting the right opportunities and understanding what to steer clear of can make all the difference. Remember, investing is a journey, not a destination. Stay informed, stay vigilant, and your investments will thank you.